it is Way Up with Angela Yee. I'm Angela Yee, and Jasmine from the Jasmine brand is here.
Yes.
And because we care, and we know people have taxes due, all right, Erica Lee is here, a tax attorney. Is that the right thing to say?
Tax attorney, that's right.
Tax attorney, okay. Actually, I actually use Eric, and he's been amazing for me. So I want to make sure that we get some of these things out because I know it can be very scary when you know you either owe money to the IRS or you just haven't filed your taxes and you don't have it together.
Right.
All right, so the deadline is usually April 15th.
That's right.
But it's April 18th this year.
It's April 18th this year. And with some of your listeners in various states, due to some of the FEMA emergency declarations, their extensions have been actually possibly transitioned all the way to October 16th.
Wow.
Nice.
Yeah. So, for example, if you're in New York and if you were part of the storms back in December, and if you live in Suffolk County, Erie County, it goes into October 16th. So it's very important for your listeners to check on the IRS website as well as the FEMA websites to make sure where their extensions may have been extended to.
Because you could have an extension and not even know it.
Right.
That's right.
And
so,
I know. Do you have to do anything for that extension? Like, you don't have to file? It's just automatically
great
extended?
question. No, it's automatically extended, but you have to look at which state it is. Like, for example, in Arkansas, where the storms that just occurred back in the end of March, their date is extended to July.
Okay.
Now, if you have a listener who believes that they won't be able to finish by July in Arkansas, then they should file an actual extension as soon as possible.
And when we talk about filing an extension, right, what's the deadline for that? Let's just say you know you're not going to have your taxes ready, and you're like, okay, look, April 18th, maybe that's your deadline. Is that also the deadline to file for an extension?
Yes, yes. So it depends if we're talking about a corporate or a personal return. If it's corporate, the deadline was March. Okay. And then if you file an extension, then it'll go into September 15th.
Okay.
Right?
So you go ahead, I'll let you finish.
No, but then if it's a personal return, April 18th right now, and then file an extension, it'll go up to October 16th. So it's basically 6 months from the date of the actual deadline.
Okay.
If they owe you money, okay, let's just say the IRS owes you money and you file late.
Yeah.
All right. Do they give you penalties for that?
They will assess late filing penalties, but there may also be interest that they pay you.
Oh.
Yeah. So it's actually, a win-win on both sides. Now, if you have any listeners who may actually have some penalties, right, there will always be some phone numbers where they can call if it is the first time they made a late filing or if there's a really good excuse for a late filing, like if they actually live in one of these areas, family emergencies, COVID, whatever. Usually the IRS will be very gracious and actually return or waive that penalty.
So at least try.
At least try.
Okay.
Definitely call.
Now, what if you haven't filed your taxes in years? There's a lot of listeners who are like, man, I haven't even done my taxes, since 2015.
Yeah.
Then what?
Well, you better get all your materials all together, because originally when your listeners go look up when can we actually file a tax return or how far back can the IRS look, right? Normally it's 3 years.
Oh, that's
Okay,
not bad.
not bad.
Forget it.
But if you do not report income and if you miss income by 25%, they can go all the way up to 6 years. 6 years. Okay. So you have a listener who hasn't filed since 2015. First off, get a professional.
Okay.
Get a professional to actually call the IRS and indicate, hey, Eric Lee hasn't filed a tax return since 2017. We are fully cognizant about that. We are trying to set up a deadline where we'll actually gather all the materials to actually send in our tax returns. 2017, then 2018, 2019. Okay. Do not think that just because the IRS hasn't contacted you that they won't.
Right.
Okay. Is there a time when they don't contact you anymore? You know how they'll be like, oh, this drops off your credit report after 7 years. Is there a period of time that they can't go back any further? They're like, okay, you got away with it because 10 years ago, you didn't file. We never called you out on it. Is it ever too late?
Technically, it is never too late. Technically, it falls under the very last moment when you actually committed the wrongdoing, right? But if you're constantly not filing intentionally, you're constantly, the statute of limitations does not run,
Right.
or it does not end. So you're constantly committing this wrong. So theoretically, the IRS can always go back to you if you have not filed a tax return.
I know this is a broad question, but how far in advance should people be preparing for their taxes? Obviously, they shouldn't wait till the week of, but if you're a regular person, how far in advance should you start, preparing for your taxes?
Well, sometimes it's hard, right?
Yeah.
It depends. For your average listener, it will be once when you get your W-2 from your employer,
Right.
and you can batch up some of your E-Trade documents or some of your
Some of those statements and
1099s.
stuff, yeah.
That's right. You should be able to file your tax return. Ostensibly, you should be okay at the end of January, right?
Okay.
Now, certainly you have some listeners who are a bit more complicated that have a bunch of businesses, right? And that may take a bit longer because you can't file the personal return until the corporate return is filed.
Right.
So that may take a little bit longer.
Okay.
All right, now let's talk about people who have kids, right? Let's just say you're not together, you have children. Who gets to file the children? Because that's a big deal. I know that's something that Jasmine was asking about as well. But how do you decide that? Is it, and let's just say you have joint custody with these kids, they spend equal amounts of time. Who files that?
Well, it depends on, first of all, if there was actually a divorce, right? Because the divorce decree would actually
maybe never
always come
married.
Say
first.
they were never married.
Say if they were never married, you would theoretically look at who is actually the higher income earner of the parents.
Okay.
Right. Now, there are many cases, including in my clients, where one just file, claim the child.
Yeah. That's
And
what we were
that-
talking about.
Yeah, that totally
happens.
messes up the other
Yes, it
parent.
does. So what do you do?
Well,
But hold on, you were saying the person that makes the most money should claim the child?
absolutely.
And why? Explain why.
Because their tax bracket is at the highest.
Okay.
They get
So
more.
whereas if a person is at the 10% bracket, right, and they don't really have much taxes to actually pay in,
Right.
and they're claiming a child, $2,000, they may not even need that $2,000 credit.
Right.
Whereas the other parent would actually
Could use
need
that
it.
credit, yeah.
That's right. Now, what can you do at that point? Hopefully it's amicable,
Yeah.
right?
A lot of times it's not, though.
Yeah.
If it's not, that's going to be a completely different issue. I mean,
Yeah, what
honestly.
can you do?
Yeah, like you were saying, like with that example that Angela just gave, that happens to people where
Right.
someone races, they may
Yeah.
have an agreement or not, and someone races to file, and
They file first.
they file
So
first
now
and they
you
claim
can't
the
file.
child, so the other person, is SOL.
Or what if both people do it?
Yeah.
'Cause
What
you
happens?
don't know.
Yeah.
Okay, well, if both people do it, then the second one to file will get notified.
Wow.
So that's
So
not
really,
good.
it's first come, first serve.
Yeah.
It's really first come, first serve. In the cases where it's amicable, let's just say that they agree, like, oh, I'm sorry, Jasmine, I should not have filed,
Right.
Then theoretically, I should amend my tax return.
Okay.
And then you're able to claim said child.
Okay.
If it's not amicable, then, that does become a very, very difficult situation.
Yeah, there's nothing you can
where-
do. It's whoever files first.
Yeah.
It's a race.
It's first come, first
Yeah,
serve.
and then that may be part of. You may have to look into the child custody as well as just like child support situations. You may have to amend. You guys may have to play within certain other contours of the relationship.
Okay. And for children, can you write things off like childcare, or what kind of things can you write
That's
off?
great.
For
Like for example, we were just talking about the dependent care. There's a dependent care credit, right? If you're working, $3,000. $3,000 of dependent care can be written off.
Okay.
$6,000 if there's more than one child.
Okay.
So that that's substantial. It used to be much, much larger, but we have a different Congress now. So I mean, but $6,000 is still better than nothing.
What are some things that we should know about, some credits that we should know about that maybe people don't commonly use enough?
Two things. One is, especially given what has happened in the markets, stock as well as in crypto last year, many listeners probably have a loss. Okay. And they're just thinking like, oh my gosh, I just lost so much money because Bitcoin just,
Right. I had
tanked
all
out.
this money in Bitcoin and
Right. And one of the things that they don't realize is they actually need to gather those statements from their investment professionals and make sure those statements are given to their tax professionals. Because even though they had a huge loss, They may have gains from other areas, so that losses could be net against. And trust me, we have so many clients who may have a brokerage account here and a brokerage account here, but only for whatever reason show the gains because they only think about the gains.
Right.
Or they don't even want to talk about the losses, right?
Yeah.
But the losses will net against the gains. That's one thing. Second of all, let's just say that there are no gains. Even if you have losses, you still get $3,000 a year.
Okay.
So let's just say I theoretically have lost $50,000 from Bitcoin last year, right? I still get $3,000 to net against my W-2 wage income at iHeart,
Okay.
which is
It's something.
something. And
Yeah.
people, a lot of times do forget about it. Another thing, and this actually I see with my friends, they have Airbnb, right? But they don't do it that often. They just have it like once a while, whatever, right? First 14 days, tax-free. First 14 days is tax-free.
What do you mean?
So, for example, if I rent out my house through Airbnb, all right, and it's $100 each visit, right?
Okay.
And I've done 16 nights of last year, right?
The
My
first 14 days
is tax-free.
Okay. I didn't know that. And that's an interesting credit.
It is, and it used to be part of wealthier individuals who had these mansions near golf courses, and what they would do during like the Masters is actually just rent out their homes
Oh,
for
so
like
this is to help
30,000.
rich people.
Of course it is.
Oh, absolutely, absolutely. I mean, the code is definitely structured to benefit the people who can hire the tax professionals, who actually have the income to actually shelter, right?
All right. And what are some things we can do to make sure we don't get audited? Because that's a really scary thing for somebody when they get that notice from the IRS
Yeah.
that they're being audited. And I'm sure there's ways that you can avoid that because what percentage of people get audited?
Very little on a certain stance, right? So there are a total of 79,000 audits last year.
That's not bad.
That's not
That
bad.
doesn't seem like a lot at all.
But the more income you have, more likely you'll get audited. Also, the more incorrect information. And so when you're talking about like audits, right? One thing that our listeners should actually pay attention to, right? The listeners here, make sure you gather all the information before the tax return is filed. Okay. So let's just say I have two W-2s, right? So I have one from iHeart and then I have one from Starbucks. Okay. And I only give the iHeart W-2 to my accountant, totally forgot about it, or maybe my Starbucks W-2 came in late, got lost in the mail, whatever, right? So I file the tax return under one W-2, forget the second one. Trust me, I'll get flagged.
Okay.
All right. Partnerships in other businesses, right?
Ooh, I have a lot of those.
You do. And at the end of the year, you're supposed to get a K-1 for every business that you're a partner of.
I can't stand when people be late with the K1. I'm like, can I get my K1? Can I get my K1?
Right.
We had that last year, right? And there's also a situation where if you miss the K1, or maybe you just have a listener who has 5 businesses, forgets to send in one K1, that will be flagged,
Okay.
right? Lastly, informational, simple stuff, social security numbers, EIN numbers, which is the number for your business,
Yeah.
as well as checking account numbers. Make sure those are correct. I know this sounds ridiculous, but every
people
time
mess up.
people mess up, even in my firm, I'll type it in and then I'll run it by my partner. I'll be like, okay, this is the number 62415 da da da, and then Christina has to like check it off. We have to do that.
Right.
Yeah.
Yeah.
Because sometimes human error, that's what it is.
Absolutely. Keystroke error, whatever it is.
I was going to ask the biggest mistake you see with people filing taxes, but is it human error or?
Sometimes it's human error, sometimes system error. The biggest one that we've been seeing in the past 2 years, people have been changing their accounts a lot, especially with stocks.
Okay.
And when they're moving from one account, let's just say Morgan Stanley to E-Trade. Okay. And maybe they have purchased Microsoft at $50 10 years ago. Then when they moved it, they did not report what they purchased it at. Okay. They sold their Microsoft at 160 today, right? Because the forms did not show the amount that was moved, when it comes to me, the tax preparer, I may see a 0. So instead of being, now when you get stock, to be taxed, you have to look at the amount that you sell it at as well as the amount that you purchased at.
Okay.
So it'd be 160 minus 50. Then it'd be 110. If I see a goose egg in one of the forms, I assume that it's 0. then I would be taxed at 160, which would be a difference of $25 per share in taxes.
Okay.
That's a big error, especially these days.
And that's only if you sell or, or move it.
Just move. Well,
Okay.
it could be moving. It could be a keystroke error within the financial planning firm. It could be like a lot of things, but we do see a lot of errors right now with what is called 1099D and 1099Bs, like where we just don't really see the historical cost of the equity or the Bitcoin.
All right, what about writing off too many things? Because that's another thing. People be like, oh, you could just write this off. You could write this off. You could write off your clothes. You could write off, all of these dinners. You could write so many things off. What is the limit? And how do you know what you can and can't write off?
Well, first of all, you have to have a business.
Right.
Right? You can't.
Let's start there.
This is just my life. I want to write off dinner.
My life is my business.
We talked about business at dinner. How do you know?
Well, first of all, you have to have a ordinary business. Okay. The expense must be substantial and traditionally related to the business.
Okay.
Okay. And if it isn't, it must be substantiated. All
Okay.
right. So if it's a meal, right? Like let's say the three of us set up a real estate company. All right. And then we had a meal. And let's just say that we had a meal in Detroit, right?
Okay.
That is obviously a business deduction. That was obviously a business meal, right? But if, say, all the three of us were just celebrating and we're just hanging out and we're going to like Avra and we're just, buying bottle service
She
and whatever.
loves Avra, by
I
the way.
love
Do you?
Avra. Yeah, the
Mediterranean food.
Yeah,
Okay.
the
Yeah.
Mediterranean. Sorry, I'm sorry.
The
off
Avra
topic.
chips.
Yeah,
Okay,
Avra chips.
sorry.
Sorry.
Yeah.
Food gets her excited.
Yeah, it does.
Okay.
No, the
you the
Avra
one,
chips
you the one
are
brought it up.
He brought up Avra.
I
Then
did.
You didn't. I didn't say anything. Then you chimed in, and then it made me think about the Avra chips. I'm sorry. Continue.
I can focus now because I'm thinking about the Avra chips. But so if we did bottle service,
Yes.
right? That's obviously not a business.
Right.
So there needs to be substantiation
Okay.
within the operations, right?
What if you're at the strip club promoting a new single?
Well, you know what? That's very, very interesting, right? Like, what is a promotional expense
Right.
versus what is actually a business expense?
Right.
Okay. Or is the promotional expense really related to business, right? We have clients who go to Vegas,
Yeah.
right? And they actually are having shareholder meetings, they're actually having these dinners, they're actually trying to promote their record or a movie or their project. Okay, that's perfectly fine.
Okay.
But then they're on the floor and they're gambling.
What did we have to? I'm sorry. Let you finish your thought.
Yeah, so then they're on the floor and they're gambling, right? And invariably every year I'll get 1 or 2 calls where I'll be like, oh, I just lost X at the tables.
Yes.
But it was a business expense.
Yeah, it's a business expense. I was with Angela. I was talking about my movie, whatever. No.
Okay.
Right? Because
No.
because you have to substantiate the business tie to it.
Right.
And then
Right.
people talk about vehicles because
What if I'm researching a movie about gambling?
well, for example, if you go, oh, that's a great one, right? That would be okay.
Right.
I mean, if you're actually doing a legitimate research, and if your business has something to do with the interview regarding this project, yeah, that would be fine.
Okay.
What do you get taxed on when you win in the casino? Like what amount? If you win more than?
Well, you're supposed to report all your gains.
Okay.
Okay. And
Okay.
this is a great question because I don't know if you win more than $1,200 at the slot machines, right? It automatically stops the machine.
Right.
Somebody has to come over
Right.
and
They're
write-
going to know.
Yeah.
Yeah, they're
But I'm
gonna
saying
know.
you win something like $500 or.
Yeah. Well, that
supposed
would
to
be
report
income.
all of it. Okay.
Okay. But one thing that your listeners should know is that the income that they made over at the win, let's just say $500, right, can be net against any gambling losses for the same year.
Okay. All right. We got to
it-
keep track of a lot of stuff.
I know. And then also one other question about, I think I heard someone say they wanted to buy a certain car because you can partially write part of it off or something like that.
Yeah.
Can you explain that?
Yeah. So, first of all, you have to have a business.
Yes.
Okay.
Again.
And then the vehicle must be at least 50% utilized within the business.
Okay.
Okay.
So if you drive to work every day.
That's right.
Is that
within the
considered-
business,
Right.
within the business, right? So, and then it must be over 6,000 pounds.
See, that's what I heard. I had to weigh a certain amount. And I thought that was kind of odd, but okay.
Well, because they don't want you to be the code is very interesting. It's not just about the money; it's about the policy, right? Like we're writing this because we're trying to promote certain behavior, right? And the reason why it's considered odd, why is it £6,000? Is because theoretically the IRS is trying to promote you to buy commercial vehicles, like true vehicles that would be used on not just a nice,
Right.
not
coupe. A BMW truck.
Well, a BMW truck could possibly qualify.
I think yeah.
Yeah.
Okay.
Let me go weigh my car.
Exactly, weigh your car. But I mean, that's why sometimes where you'll see like some of the more expensive cars, the Rolls, Porsches now, they're exactly within £6,000 now.
Ooh, on purpose, so you could, for the rich people to write it off. What about all these people working from home now and writing off,
The home
your
office.
maybe your rent? Can you write off part of your rent? Can you write off if you have a mortgage part of that because you're working from home?
Well, yes.
That's a good question.
Yeah, you have to look at the total square footage of the house, okay, and then how much you actually devote to your business.
Okay.
So then it must be fractional or in proportion to that. Otherwise, you could take the standard calculation, which is $1,500.
Okay. Yeah, because let's just say our producer, Dan, he edits a lot of stuff at home. He might leave here and then go home, work into the night, editing. That counts?
Well, if Dan has a separate business, yes.
Okay.
Yes, but if he's just doing it as an employee of iHeart, it does not.
Ooh.
Okay.
Yeah.
You have a separate business. Oh, okay, let's get it together, sir. You better talk to your accountant if he's not like mine.
We'll talk later, Dan.
All right, so we just want to make sure that everybody knows that they got to hit these deadlines. And can you call, let's just say there's interest because you paid late. Another thing that I know you've always told me to do is you have to make a payment, even if you're getting an extension.
Yeah.
Can you talk about that? Because that helps people if you owe money.
Yeah. So, for example, we're coming up, right? April 18th. And if you need to speak with your tax professional and determine what is actually my projected or estimated tax. Even if I file an extension back in all the way into October, right? That doesn't stop the IRS from actually assessing the tax that I truly owed back in April. Okay, so even if it's an extension, it doesn't mean that, I stopped the payment or the calculation for the payment. I still owe it in April.
Okay.
So that's very, very important.
Okay.
Right. So that's why you always tell me, make sure you make some type of payment because then it's less interest.
Yeah.
Or you can estimate what you think you might owe.
That's right. And that's the job of your professional, to actually estimate the amount that you owe, right? In some cases, some of your listeners may withhold or overpay into the system.
And then they owe you money.
That's right. Then they would, the IRS would then owe that listener money. That's
Right.
correct.
Okay.
Yeah. Yeah. So it just depends on the individual's withholdings.
All right. We just want to make sure everybody's getting to the money.
Yeah.
And
It's a great conversation.
yeah. So I just want to thank you. Is there anything that we missed that you feel like is important for our listeners to know as tax time is approaching us, April 18th, unless you live in one of those areas where you get an extension?
If any of your listeners are actually looking to purchase any EV cars, especially this year, the rules have definitely changed. It used to be just a $7,500 energy credit for purchasing an EV car. The rules are completely different. First of all, the manufacturer actually has to qualify with the federal government. Okay. That's not on your listener, but what will be on your listener is whether or not that car, let's just say it does qualify. If that particular car actually qualifies. So when they purchase an EV, they need to ask the dealer if this particular car with this VIN number actually qualifies for
Oh,
tax
wow.
credit.
You have to know the VIN number and everything.
Okay.
Yeah,
All right.
they have to look it up. But
This is a lot of work. That's why you need a tax attorney.
For sure.
I'm not doing any of this by myself because I feel like there's more of a chance you'll get audited too when you do your taxes on your own.
There can be, definitely, because again, there is the less chance of error.
Right.
When you have more people look over the tax return.
Right.
Okay.
Do you think if you have just a straight up employee, it's just a standard check you get every single week or every 2 weeks, and then is it necessary to hire someone, or do you think something that is just very straightforward is something you can do yourself?
It depends. It depends on the bandwidth of the listener, right? It depends on what's actually going on in his or her life. It also depends on the amount of that check.
Right.
What I think everyone kind of knows where their capabilities are. Yeah. And I'm very good at other people's finances. You can ask my husband. I'm not very great with my own.
Okay.
Right?
Okay.
And so...
So who does your taxes?
Who does my taxes? Thankfully, I have a partner, right? Thankfully, Christina does my taxes. Howard does my taxes, I don't do my own personal taxes. It's kind of like being a doctor, right?
Yeah.
I should not be my own physician.
Okay. No, I think that's important too because there might be things like we just learned a lot of different things about tax breaks that maybe you don't know about. And so if you're trying to do your own, you might be neglecting
Yeah, you might be missing.
money. Yeah, money that you could be getting. So I do feel like that is important.
Yeah, absolutely. Absolutely. And, it's an important conversation. One thing for your listeners, when you get a tax professional, right, make sure, and this is one thing that I learned from my mentor, Donald. He told me that when you have a client, go through the tax return with your client and have them explain it back to you.
Okay.
Because nobody's life is reduced onto one line of a tax return.
Right.
Nobody's life is just like, oh, this is my income. That's it.
Right.
Right. There's so much that went into it. So make sure that your tax professional actually gives you the courtesy of like going through it and explaining what this line meant, this is how the calculation is.
Okay. All right. Well, good. You have a lot of work cut out for you then. There's a lot of lines and things that I have to deal with. But I appreciate you for coming through and for volunteering to do that because I know tax season is always a nerve-wracking time for me. And so for a lot of people, and for some people, it's a great time because you get a check.
That's right. Yeah. So
How is it? How am I looking?
you're looking good.
All right.
You're looking good.
Okay.
Yeah, you did give me a pound of documentation, though. So
At least I keep all my documents together. It's the least I can do.
Right.
yeah, so I have to get a crate to like haul all your stuff back.
So funny.
But thank you so much, Eric Lee. And where can people find you?
You guys can find me over at info@intrinsic.biz, info@intrinsic, intrinsic.biz.
And don't forget to give to charity, guys. That's also something that makes you feel great, and you can write it off.
Oh yeah, absolutely.
Donations.
Make sure that you gather all of your receipts from the charities. Make sure that the charities are legitimate. Make sure that they actually provide you with the letters near that time at the end of the year.
Yeah.
Because if you don't get that letter, it's going to be difficult to claim.
Can you claim your friends on your taxes?
I wish.
Oh, okay.
Angela wants to claim me.
I do. She's like my child.
You could claim me.
All right, it's Way Up with Angela Yee. Let's get it.